Welcome to a deep dive into the world of economics, where we're about to explore the looming risks of a recession. Fasten your seatbelts as we delve straight into it. Now, understanding recession risks is crucial for any astute observer of economic trends. Enter Jeffrey Schulze, the mastermind behind the Recession Risk Dashboard, a tool that gauges the health of our economy. Currently, the odds of a recession are hovering around 55%, but there's a glimmer of hope. Schulze suggests a 45% chance of what's known as a soft landing. Intriguing, isn't it? Let's move forward to understand the indicators that signal a recession. What signs should we look for when anticipating a recession? Let's explore. As we delve into the world of economics, we often see a non-linear nature of data as a recession approaches. This means that economic indicators don't always follow a straightforward path. Take, for instance, job creation and consumer spending. These two aspects of the economy can be humming along nicely and then suddenly take a nosedive, signaling trouble ahead. Now let's talk about the Recession Risk Dashboard. This tool is a bit like a weather forecast for the economy. It uses a color coding system to signal the health of various economic indicators. In the last quarter alone, we saw 3 indicators upgrade from red to yellow. Red indicates a high risk of recession, while yellow suggests moderate risk. So these upgrades are somewhat encouraging, but it's important to note that the overall signal remains red, indicating that caution is still the order of the day. Another key measure to keep an eye on is the Leading Economic Indicator, or LEI, index. The LEI is a composite of 10 economic indicators that tends to lead overall GDP. When this index starts to decline, it's often a sign that the economy might be heading for a downturn. Lastly, we need to consider the increasing signs of balance sheet fatigue among consumers. This refers to a situation where consumers are becoming increasingly burdened by debt, which can lead to a pullback in spending. And as we know, consumer spending is a crucial driver of economic growth. These indicators are vital in understanding the possible onset of a recession. Now let's take a look at how monetary policy can influence these risks. Monetary policy plays a crucial role in managing recession risks. Let's understand how. The U.S. Federal Reserve, often referred to as the Fed, has a significant role in maintaining the balance of our economy. One of their key responsibilities is to manage inflation, and they do this by manipulating interest rates. Recently, the Fed has been working diligently to bring interest rates back to a neutral level to combat high inflation. This move, however, is a bit of a tightrope walk. On one hand, it's necessary to keep inflation in check, but on the other, it increases the risk of a policy error that could inadvertently lead to a recession. The decision to raise rates isn't made lightly. It's influenced by key data points like the Consumer Price Index and the University of Michigan Index of Consumer Sentiment. These indicators provide insights into the current state of the economy and consumer confidence, which are vital considerations in monetary policy decisions. The market projects a series of additional rate hikes this year. If these projections hold true, it would result in the second largest cumulative rate increase since the mid-50s. That's a historical significance that cannot be overlooked. But it's important to remember, monetary policy isn't a magic wand. While it can influence economic conditions, it may have a smaller impact in the face of supply shocks such as higher energy prices. It's a tool, but not a cure-all. So while the Fed's actions are aimed at maintaining economic stability, they can also contribute to recession risks. Now let's wrap up with a look at potential signs of a slowdown. While we hope for the best, it's wise to prepare for potential economic slowdowns. Let's identify some early signs. One of the key indicators of a looming slowdown is a cooling activity in the housing market. When the demand for homes begins to wane, it often signals that consumers are becoming wary about their financial future. This could be triggered by factors such as rising interest rates or job insecurity. Speaking of jobs, hiring freezes or layoffs in vital sectors like technology can also serve as red flags. As companies start to tighten their belts in anticipation of leaner times, this can ripple outwards, affecting consumer confidence and spending power. However, it's crucial to remember that a recession is not a certainty. The Federal Reserve has tools at its disposal to pivot and stimulate the economy. Other positive developments, such as technological advancements or policy changes, could also emerge, potentially offsetting some of the negative trends. For long-term investors, periods of economic slowdown can present unique opportunities. While it may be tempting to panic and sell, a patient and strategic approach often pays off in the long run. Look out for undervalued assets, companies with strong fundamentals that are weathering the storm, and sectors that tend to thrive in slower economies. Understanding these signs can help us navigate economic uncertainties. Remember, knowledge is power. We've covered a lot of ground today, from recession indicators to monetary policy impacts and potential signs of a slowdown. It's crucial to comprehend these recession risks and stay abreast of economic trends. Remember, knowledge is power in an ever-changing economic landscape. Stay tuned for more insightful discussions on economics. Don't forget to subscribe and share this video with fellow economic enthusiasts. Until next time, keep your eyes on the markets and stay informed.